Welcome investors. A hotter than expected inflation report. Does that throw a wrench in the Fed's plan to cut interest rates in the next few months? And mortgage rates dipped to a 5-week low. What does that spell for the real estate market going forward, possibly throughout 2024 and in the subsequent years? And then finally, there's an immense narrative right now. Soft landing, no recession, everything is good. Well, I found a reference that we can look at through a history of U.S. economy, a history of time. We're going to travel back in time and find what is the actual time period where we can actually say everything is good. We are out of the woods. So up first, some data released this week. All right, what I have on your screen here is the U.S. economic calendar, this week's major U.S. economic reports. In this column, we have actual data that we received in the medium forecast. And I'm going to start here with consumer price index, which is inflation, and we actually got 0.4 with expectations 0.4. Core inflation actually got 0.4 and expectations were 0.3, and the core is just excluding food and energy, which are very volatile. Retail sales, so consumer spending, expectations 0.8, and we got 0.6 even with the tax refund, so a little below expectations. Consumer slowing down. This is a little worrisome. Producer price index, so that's the wholesalers, what are they paying for items? Well above expectations. We will see if that has downstream effect. Now, I want to show you the trend of inflation right now because people are panicking. Oh my gosh, we got a hot inflation report. But what is the overall long-term trend? We had a huge spike in 2021 and we've been decelerating ever since then. It's not going to be a straight line down. There's bumps in the road unless we're in a major economic downturn, which we're clearly not in right now. The current economic data still shows strength. Leading economic data shows weakness, that there is possibly a recession. And if you watch our last video, we touched on all this with leading, lagging, and coincidental, which are current indicators. And those are the ones that are strong. So next, let's shift gears. We'll move to the real estate market. And let's talk about where the price of real estate is going to go, where is the supply going to go. And we need to keep in our minds that, man, there's so many different real estate markets. You have the northeastern states, you have the western states, the southern states. They're all doing a little bit different things. And during the pandemic period, the southern states' prices went up really well because there was a lot of migration from the northern states. And we're starting to see that flip right now, where a lot less migration than there were, and some are actually migrating back up north because prices came up so much during the pandemic in 2021 because there was that influx. So drove up prices. Now prices are much less affordable. And also we have some problems in the other states with insurance costs. Insurance premiums have went up significantly, especially in the state of Florida, which I am located in. It's very tough to get homeowners insurance, and a lot of that has to do with the weather. And then property taxes shot up because home values are higher than they previously were. So those are issues and problems that are getting factored into, hey, do I want to move to the southern states? And it's just kind of unaffordable right now. So let's get into some data on what we can see with supply and housing prices, and I'll clarify. But before we do, if you're finding value from this video, be sure to like the video and subscribe to the channel so you can stay ahead of the curve. All right, take a look at this Market Watch article here. So mortgage rates dropped to a 5-week low. Is that showing signs that interest rates are going to come down? I'm skeptical. Mortgage rates fell to the lowest level in 5 weeks, bringing some good news for home buyers. 30-year fixed rose and averaged 6.74% as of March 14th. It's down 14 basis points, which is 0.14% from the previous week. A year ago, 30-year was actually averaging 6.6, so we're still higher than we were a year ago. So, I mean, the interest rates really haven't come down. They've come down a little bit, below 7% now, but they're still really high. Prices are still really high. Limited supply. Where is the supply potentially going to come from to bring down prices? Because the economy's still hot, CPI is still hot, the Fed can't cut interest rates. So this is a monthly supply of new homes in the U.S. So new builds dropping. That is increase of supply. And you'll notice where we are right now, where our supply is ticking back up for new home builds, that people aren't selling their current homes because one, they probably get good interest rates, or two, the prices are unaffordable, so where are they going to go? Let's start back in the 60s. It's very interesting. When you'll notice a trend here. Look at supply. Supply starts to shoot up, we get a recession. Supply starts to shoot up, we get a recession. Supply starts to shoot up again, we get a recession again here in the 90s. This one was a little different. This is a dot-com that was more of a stock market related bubble. 2008, 2009 shoots up and recession. Coronavirus pandemic, that was just a complete anomaly, black swan event. But again, here we are, we're shooting back up today. We are seeing new home supply, construction bills, because there is some confidence with the no recession, soft landing narrative that we're seeing right now. So they're starting to feel confident. So they're going to start increasing the supply with new home bills coming to the market. And then once that happens, do prices start coming down? And does that cause people to, I was going to list my house, I better do it right now. Does that where the secondary supply comes from? And with a lot of supply and slower demand right now because consumers are strapped, they're not spending as much, their debt level is very elevated. So we're seeing all these in short-term real estate investors who are now, I can't rent out my home. There's no one making bookings. I have some clients in North Carolina, Arizona, Florida, all over the United States, and it's a pretty similar story, and it's really locationally important where your location of your Airbnb is, because obviously if you're on the beachfront, your house is probably, your Airbnb, your short-term rental is probably still doing well. However, if you don't have a great location, you're not renting that place. You're going to have a tough time. So that's possibly where some more inventory can come from. So I would expect interest rates to remain high right now, probably until June, July, when the Fed does end up cutting interest rates. Then that's the forecast right now. If we keep getting hot inflation data, the trend starts to change, we're going to move our timeline back. But that's what we're looking at right now. But absolutely open-minded on that. That's the thesis at this point. Interest rates are going to remain high, and supply was going to start to tick up. Demand still remains low. Prices start to come down, become more affordable. So patience, I think, is going to be on your side. All right, let's shift gears to our final thoughts here. The narrative. If you turn on the TV, if you're reading news articles, doing a Google search, you just can't help but find soft landing, no recession. But is that the truth right now? And what I've talked about on this channel several weeks in a row, or not necessarily several weeks in a row, but previous videos, is something called the inverted yield curve. Inverted yield curve, all right? So we're going to go through this together, and we're going to find the timeline when we can feel safe as investors that we actually are out of the woods, and not just say, hey, everything's good right now because the data right now is good. When the data right now, the coincidental, remember last video, coincidental means current information, of course is going to be good until it's not, okay? So let's take a look at this together. Okay, what I have on your is the St. Louis Fed, the 10-year Treasury minus the 2-year Treasury. And in this case, when we get an inverted yield curve, the 2-year is yielding a higher percent return than the 10-year. And you'll notice the zero line right here, whenever the 2-year is higher than the 10-year yield, we've got an inverted yield curve preceding every single recession 100% of the time. So let's start here. Inverted yield curve, recession in the early 80s. All right, inverted yield curve, recession late in the 80s. Immediately when we were coming out of the inverted yield curve, we got the recession. Let's check out in the 90s. We got an inverted yield curve. Comes out of this inversion. How many months later? We got 1, 2, 3, 4, 5, 6. 6 months. Got the recession. Interesting. Okay. Let's move on to the early 2000s. We got the inverted yield curve. Out of the inverted yield curve, 1, 2, 3 months later, recession. So we got a 3 to 6 months. Now 2008, 2009, inverted yield curve, 1, 2, 3, 4, 5, 6, 7 months. So we got 3, 6, and 7, 8 months. And then we got the recession. We have to come out of this inversion first before we say we're in the clear. We are clearly still inverted. We clearly still have an inverted yield curve right now. So we need to come out of that. We need to count down somewhere between 3 months and maybe 9 months, maybe a year to feel really safe. And that doesn't mean that we don't take investment shots right now. We just have to be aware of that prices are high in assets. Prices are high in the stock market, making all-time highs. we were not out of the woods yet, and it would be an anomaly if we don't get a recession. The probability is higher in the recession camp than it is in the soft landing. The soft landings are rare. So is this time different? Has anyone ever heard this before? This time is different. Everything is just fine. That should ring warning bells. When people become sanguine and everything is okay, everything is great, we got a soft landing, that's when we can start to say, hey, let's take a step back, let's be a little patient and understand that we're not clear just yet. Stick with us. We'll keep you updated, and we can really analyze this together to find out when we truly are clear. And also we'll discuss, hey, how can we take advantage of right now this volatile market that we currently are in? So again, stick with us. Expertise you deserve, experience you can count on.